ExamPrep.School. Vermont Producers Personal Lines Insurance Exam, exam code SERIES 14-39. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Auto insurance, dwelling policy, farm coverage, general insurance, homeowner's policy, insurance regulation, other coverages and options, property and casualty insurance basics. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under Vermont law, which of the following is a requirement for a non-resident insurance producer to obtain a Vermont license? A. Maintain a principal business address in Vermont. B. Pass a Vermont-specific ethics examination before issuance. C. Hold a valid equivalent resident license in the home state. D. Complete Vermont. Continuing education hours prior to initial licensure. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is C. The correct answer is that non-resident producers must hold a valid resident license in their home state that is equivalent in scope to the Vermont license they seek. Reason A is not correct. Non-residents are not required to maintain a Vermont business address to be licensed. Reason B is not correct. Non-resident applicants are not required to pass a separate Vermont ethics exam before initial licensure. Reason D is not correct. Continuing education is required for renewal, not before the first issuance of a license. Question 2. Before sitting for the Vermont Personal Lines Producer Examination, an applicant must complete how many hours of state-approved prelicensing education? A. 10 hours. B. 40 hours. C. 20 hours. D. 60 hours. The correct answer is C. The correct answer is 20 hours, which is the minimum required prelicensing education for a personal lines producer in Vermont. Reason A is not correct. 10 hours is insufficient. Vermont mandates more education for personal lines licensure. Reason B is not correct. 40 hours applies to life and health licenses, not personal lines. Reason D is not correct. 60 hours exceeds the requirement and is not mandated for personal lines producers. Question 3. A Vermont licensed insurance producer must complete 24 continuing education CE hours every 2 years, including at least 3 hours of ethics CE. At the end of the current biennial CE cycle, the producer has completed 30 CE hours with 5 ethics hours. How many of the excess CE hours can be carried forward into the next 2-year cycle? A. 0 hours. B. 12 hours. C. 6 hours. D. 24 hours. The correct answer is C. This option is correct because Vermont allows a producer to carry forward up to 1/4 of the 24-hour biennial requirement, which equals 6 excess CE hours. Reason A is not correct. Vermont does permit some carryover of excess CE hours rather than none. Reason B is not correct. The maximum carryover is limited to 1/4 of the requirement, not 1/2. Reason D is not correct. Carrying forward all required CE hours exceeds the state's permitted carryover cap. Question 4. Under Vermont insurance law, when the commissioner issues a cease and desist order, it generally becomes effective. A. After a 10-day notice period. B. Immediately upon service. C. Only after completion of an administrative hearing. D. Following judicial review. The correct answer is B. Under Vermont statutes, a cease and desist order issued by the commissioner takes effect immediately upon service and remains in force until modified or vacated following due process. Reason A is not correct. There is no mandatory waiting or notice period before the order becomes effective. Reason C is not correct. A hearing may be requested after issuance, but the order is effective immediately without prior hearing. Reason D is not correct. Judicial review may occur later, but the order does not await court approval to take effect. Question 5. Under Vermont insurance statutes, the commissioner may impose an administrative penalty of up to how much for each act or omission in violation of the law? A. $500. B. $1,000. C. $5,000. D. $10,000. The correct answer is B. Pursuant to Vermont law, the commissioner may assess an administrative penalty of up to $1,000 for each individual act or omission that violates the insurance statutes. Reason A is not correct. The statutory maximum exceeds $500 for each violation. Reason C is not correct. The per violation cap is lower than $5,000 under Vermont law. Reason D is not correct. Penalties do not reach $10,000 for a single act or omission. Question 6. A Vermont producer receives a written notice on March 1st stating that an administrative hearing regarding alleged licensing violations will occur on March 9th at the Department of Financial Regulation. Under Vermont's hearing notice period requirement, what is the status of this notice? A. The notice is sufficient because Vermont law only requires at least 5 days written notice. B. The notice is insufficient because Vermont law requires at least 10 days written notice. C. The notice is sufficient because Vermont law requires at least 8 days written notice. D. The notice is insufficient because Vermont law requires at least 15 days written notice. The correct answer is B. Vermont statute mandates a minimum of 10 calendar days written notice before an administrative hearing. Because the hearing was set for 8 days after notice, the period falls short of the statutory requirement and is invalid. Reason A is not correct. 5 days is too short under Vermont regulations, which require 10 days of advance written notice. Reason C is not correct. 8 days is still below the statutory 10-day minimum, so it does not meet the requirement. Reason D is not correct. 15 days exaggerates the requirement. Vermont law sets the minimum at 10 days, not 15. Question 7. Under 18. USC 1033. What is the maximum fine and imprisonment for an individual convicted of engaging in the business of insurance without a license? A. Up to $100,000 fine and up to 2 years imprisonment. B. Up to $250,000 fine and up to 5 years imprisonment. C. Up to $50,000 fine and up to 1 year imprisonment. D. Up to $10,000 fine and up to 6 months imprisonment. The correct answer is C. This provision classifies unlicensed insurance business as a misdemeanor punishable by a fine not exceeding $50,000 in imprisonment for no more than 1 year as specified in the statute. Reason A is not correct. This exaggerates both fine and term beyond statutory misdemeanor limits. Reason B is not correct. This inflates felony-level penalties unrelated to the misdemeanor framework. Reason D is not correct. This understates the statutory maximums for both fine and imprisonment. Question 8. Under 18 U.S.C. 1033, waivers permitting a previously disqualified individual to engage in the business of insurance may be issued for a maximum term of how many years? A. 5-year period. B. 2-year period. C. 1-year period. D. 10-year period. The correct answer is A. The statute authorizes waivers for a maximum duration of 5 years before requiring renewal or reapplication. Reason B is not correct. This understates the authorized duration specified by the statute. Reason C is not correct. Statute sets a longer maximum term, making a 1-year limit too short. Reason D is not correct. This exceeds the maximum term allowed under the statutory waiver provision. Question 9. Which of the following most accurately defines speculative risk? A. A type of risk characterized by the possibility of loss or absence of loss. B. A situation involving the chance of financial gain or the chance of financial loss. C. A risk voluntarily assumed to reduce insurance costs. D. An exposure to an event that cannot be quantified or measured precisely. The correct answer is B. The correct answer defines speculative risk as an uncertain event that can result in either a financial gain or a financial loss. Reason A is not correct. This describes pure risk, which entails only the possibility of loss or no loss, not potential gain. Reason C is not correct. This refers to risk assumption or retention strategies, not the nature of speculative risk itself. Reason D is not correct. This describes an uninsurable or immeasurable risk, rather than one that carries potential gain and loss. Question 10. A commercial property manager conducts a risk assessment and identifies exposures such as fire, flood, and vandalism that can only result in financial loss and never produce a gain. According to standard risk classifications, which type of risk best describes these exposures? A. Pure risk. B. Diversifiable risk. C. Non-diversifiable risk. D. Speculative risk. The correct answer is A. Pure risk involves situations that result only in loss or no loss, with no chance for gain, matching exposures like fire, flooding, and theft. Reason B is not correct. Diversifiable risk refers to risk that can be mitigated through portfolio or operational adjustments, not the inherent loss-only exposures described. Reason C is not correct. Non-diversifiable risk affects entire markets or economies, rather than isolated property events that cause only loss. Reason D is not correct. Speculative risk entails both loss and gain possibilities, whereas the scenario specifies only potential losses. Question 11. Which of the following best describes the ownership structure of a stock insurance company? A. Ownership rests with shareholders who hold transferable shares of stock. B. Ownership rests with policyholders who may receive dividends based on surplus. C. Ownership rests with individual subscribers managed by an attorney in fact. D. Ownership rests with underwriters grouped in syndicates under a central agent. The correct answer is A. A stock insurance company is a for-profit insurer owned by investors holding shares of stock who elect the board of directors and share profits through dividends. Other forms, such as mutuals, reciprocals, and Lloyd's associations, have distinct ownership structures. Reason B is not correct. That ownership model applies to mutual insurance companies, not stock companies. Reason C is not correct. This describes the reciprocal insurer model, which is managed by an attorney in fact on behalf of subscribers. Reason D is not correct. This ownership structure characterizes Lloyd's syndicate underwriters, not stock insurers. Question 12. Following its fiscal year results, a mutual insurer declares a dividend of 20% of each policy's annual premium due to favorable loss experience. The insurer then levies an assessment of 5% of each policy's original premium to cover unexpected claim costs. If a policyholder paid $1,000 in annual premium, what is the net amount they receive? A. A net credit of $150. B. A net credit of $200. C. A net credit of $50. D. A net debit of $50. The correct answer is A. The net amount is determined by subtracting the 5% assessment, $50, from the 20% dividend, $200, resulting in a $150 credit to the policyholder. Reason B is not correct. This reflects reporting the full dividend amount without subtracting the assessment. Reason C is not correct. This result would occur if the dividend percentage were confused with a smaller rate before subtraction. Reason D is not correct. This reverses the credit and charge, treating the dividend as a liability rather than a return. Question 13. Within the context of an insurance contract, consideration is best defined as A. The insurer's risk assessment and the insured's full disclosure of material information. B. The insurer's promise to indemnify and the insured's payment of the agreed premium. C. The formal offer by the insured, acceptance by the insurer, and delivery of the policy document. D. The insurer's underwriting commitment and the producer's authority to bind coverage. The correct answer is B. This option is correct because consideration in insurance consists of the insurer's promise to pay covered losses in exchange for the insured's premium payment. Reason A is not correct. Risk assessment and disclosure relate to representations and warranties, not the exchange of value between parties. Reason C is not correct. Offer, acceptance, and delivery describe mutual assent and formation, not the bargained-for exchange. Reason D is not correct. Underwriting commitment and binding authority concern producer roles, not the contractual exchange of promises and payment. Question 14. Under standard contract law principles in insurance, which of these parties most clearly lacks the legal capacity to form a binding policy? A. A legally emancipated 17-year-old purchasing personal auto coverage. B. An individual formally adjudicated mentally incompetent by a court. C. A corporation in bankruptcy seeking commercial property insurance. D. An adult purchasing homeowners coverage through a licensed producer. The correct answer is B. This option is correct because a court-adjudicated mentally incompetent person lacks the capacity to enter into any valid contract. Reason A is not correct. A legally emancipated minor is treated as an adult and possesses full capacity to contract. Reason C is not correct. Filing for bankruptcy does not remove legal capacity to form contracts. Reason D is not correct. A mentally competent adult has full capacity to enter into an insurance agreement. Question 15. A small business owner purchases a business owner's policy, BOP, that includes an annual premium adjustment endorsement stating, if actual payroll differs from the estimate by more than 10%, the insurer may adjust the premium. The endorsement's language is ambiguous about how the adjustment is calculated. If a court applies the doctrine of adhesion to this endorsement, how would the ambiguous term most likely be interpreted? A. The court will refuse to enforce any adjustment under the endorsement due to its vagueness. B. The court will adopt the insurer's interpretation of the endorsement wording. C. The court will rewrite the endorsement to establish a fair adjustment mechanism. D. The court will construe the ambiguous endorsement term in favor of the insured. The correct answer is D. Under the doctrine of adhesion, any ambiguity in an insurance contract is construed against the party that drafted the policy, typically the insurer, and thus interpreted in the insured's favor. Reason A is not correct. Courts do not refuse enforcement for ambiguity. They construe unclear terms against the drafter rather than voiding the provision. Reason B is not correct. The doctrine of adhesion prevents courts from adopting the insurer's interpretation when ambiguity exists, favoring the insured instead. Reason C is not correct. Courts generally do not rewrite policy language. They interpret ambiguous provisions against the drafter rather than reform the contract. Question 16. Which of the following accurately contrasts an open peril policy with a named peril policy? A. Open peril policies require additional endorsements to cover listed perils, whereas named peril policies automatically include all common perils. B. Open peril policies cover only the perils explicitly listed, while named peril policies cover all perils except those specifically excluded. C. Open peril policies cover all perils except those specifically excluded, whereas named peril policies cover only perils explicitly listed in the policy. D. Open peril policies cover perils only if they are specifically endorsed, while named peril policies provide coverage for every peril not mentioned. The correct answer is C. The correct answer is that open peril policies cover all perils except those specifically excluded, while named peril policies cover only those perils explicitly listed. This distinction clarifies that open peril policies provide broader coverage subject to delineated exclusions. Reason A is not correct. This incorrectly implies that open peril policies depend on endorsements to cover listed perils, which misrepresents their broader scope. Reason B is not correct. This reverses the definitions by stating that open peril policies cover only listed perils, which is incorrect. Reason D is not correct. This falsely claims that open peril coverage requires specific endorsements, contradicting the absence of exclusions principle. Question 17. Which of the following best exemplifies an indirect loss in property insurance? A. The expense to replace siding damaged by hail. B. The lost rental income incurred while a rented property is being repaired. C. The decrease in market value of a home after windstorm damage. D. The cost to clean up debris after a covered fire. The correct answer is B. Indirect loss refers to consequential financial impacts following a direct physical loss, such as lost rental income during repairs. Reason A is not correct. This represents a direct loss as it is the immediate repair cost for physical damage. Reason C is not correct. This describes a loss in property value, which is treated as a direct loss of the asset. Reason D is not correct. This pertains to the direct cleanup cost of debris removal after a peril has occurred. Question 18. Which statement most accurately defines the proximate cause doctrine in insurance? A. It requires the insurer to cover losses from every possible cause if not explicitly stated. B. It refers to the final event nearest in time that directly causes damage. C. It denotes any cause that is not specifically excluded by the policy terms. D. It identifies the initial unbroken event that sets off a sequence of events leading to loss. The correct answer is D. The proximate cause doctrine determines the original event that began an unbroken chain of causation resulting in loss, focusing on the dominant initiating cause. Reason A is not correct. This incorrectly suggests coverage extends to all unspecified causes, which misrepresents the doctrine. Reason B is not correct. This mistake characterizes proximate cause as the last event rather than the initiating one. Reason C is not correct. This conflates proximate cause with exclusions instead of identifying the causal event. Question 19. A homeowner's 10-year-old roof had a replacement cost new of $15,000 and a salvage value of $2,000. After a covered peril, what is the actual cash value? ACV the insurer will pay. A. $7,500. B. $15,000. C. $12,500. D. $8,500. The correct answer is D. The correct answer is $8,500 because depreciation is computed on the depreciable base, replacement cost less salvage of $13,000, over its useful life, resulting in a $6,500 depreciation deduction. Reason A is not correct. This ignores the salvage value when calculating depreciation. Reason B is not correct. This fails to account for any depreciation. Reason C is not correct. This subtracts salvage instead of the full depreciation amount. Question 20. A homeowner's policy provides replacement cost coverage on a dwelling with a $500 deductible. A covered partial loss requires $20,000 to restore. How much will the insurer pay? A. $19,500. B. $20,000. C. $19,000. D. $18,500. The correct answer is A. The correct answer is $19,500 because replacement cost coverage pays the full restoration cost less the deductible. Reason B is not correct. This amount ignores the deductible and overstates the payment. Reason C is not correct. This applies the deductible twice, understating the payment. Reason D is not correct. This uses an incorrect deductible amount, understating payment further. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.